want to talk about rolling up an initial out-of-the-money call. Trading an out-of-the-money covered call looking to create a dividend-like income. Stock starts to move up. Now, is it better to roll the call, or the question was, convert it to a bull call spread? Anthony asks, if you have a covered call position with a call 21 days to expiration, a delta of 15 to 20, that means you're going out of the money. He's likely hoping that the call is going to expire worthless. He's going to keep the stock, trying to create a dividend-like income every 21 days against the position to lower the cost basis of the stock with a small probability, only a small probability being assigned. Stop begins to move up. Can you convert the position to a bull call spread, or is it better to roll the call in order to prevent assignment? Well, this would likely depend on your trading plan and goals. Converting it to a debit spread, what would we have to do? As the stock's moving up, we have to buy a lower call, but it's going to be at a higher price, meaning a higher price than what you probably initially collected for the short call premium. But also as the stock's moving up, that also means that those call options you're looking at below your current price have increased more. Why is that a problem? Because the long call may negate the stock assignment, or it might give you the right to buy back the stock at that price. However, you might not be able to buy back that call, or buy that call, below the short call, where the cost of that call is less than the difference in strike prices, and it even makes sense to convert it to a debit spread. You'd be putting yourself at a loss or less of a return by doing that, but you would leave the upside open. Rolling the covered call up to avoid assignment if the new strike is not reached is a possibility, and that's the most common approach. And it's usually done if you want to hold the stock longer term without being assigned. Your trading plan is to collect a dividend-like income on a regular basis. In that case, you just roll the call up, not worry about converting it to a debit spread or doing any type of those adjustments. Now, but to be fair, let's use PowerOptions. Let's take a look at evaluating the rollout opportunities and then manual adjustments in this case with the other positions, okay? So, am I back where I want to be? Not yet. So just as before, with Eileen's position, we're going to the portfolio tools. We've got the covered call. I'm using Arista. On January 17th, Arista was trading at 117.18. Not quite the 0.15 delta, but an out-of-the-money 0.2 delta, 128 call for February 3rd. Next week's expiration was trading at 128. Now, the stock's moved up to 126.06 at the close. It was at 127.60 or so, I think, when I was doing this. So it pulled back a little bit, but that's fine. It's at 126.06. It's getting closer. So let's go ahead and evaluate. What would I do here? Now, before I do that, let's scroll over here. It's an out-of-the-money call. So naturally, if I get assigned here, and I'm not at assignment yet, but the max return if I get assigned is 10.4%. I wouldn't mind making that, but again, Anthony's concept is he wants to hold it long-term and collect a dividend-like income and not worry about assignment. And liquidation right now is at 6.9% return. Very well. We know where we stand right now. As before, we go to position actions and then position analysis. Scroll down here, and we've got what our return is, as we showed before, more details in liquidation value, future expiration value. And then we see our rollout opportunities, how we can increase the potential return and lower the probability. So I could roll up to the 130 call for a new premium of 143. Now, we collected 128. It's going to cost me $2.15 to buy it back, so I'm down about 67 cents. Oh, wow. I'm sorry, my math was really off on that. Sorry, folks. We're down about 87 cents, but we're going to collect another 143. So I'm staying positive 56 cents a premium, but only a 30% probability of being assigned at the new 130 call. Or we could go a couple weeks out, get a $1.98 premium, keep 111, 35.9% probability below. Okay, and there's other ones, but then the adjusted net profit is going to get smaller and smaller. We could go 21 days out to the 17th. Ooh, a profit of 328 on the 130 call, 38.4%. Okay, so as always, it's great to see things numerically, but while you're here, you can go to Simulate Trade and see the comparisons side by side. Current potential return of 6.9% with a maximum of 10.4. As we saw doing this adjustment, we collected 128. It's going to cost us $2.15 to buy to close this call. We're going to get $2 more up to $1.30. Going to lower the cost basis down to $113.90. The max potential of 14% if we're assigned at $130. We've given ourselves another 4-point cushion. Now we could go higher up, but we're not going to start seeing those premiums there. The counter to the buyback cost of $2.15, maybe it'd be at $135. But again, that's just rolling for a break even. We still have the $128 in play. Here we're rolling for a reasonable credit, even if it's only 4 points away from where we are right now. So we know how the rollout works. We know the concept behind it. I'm moving out in time, I'm moving up in price, keeping that probability or delta in the range that you want, but I know that even if I'm rolling for a credit, it's going to be much smaller. How would this compare now from what we initially entered on the position? Well, let's take a look at that profit and loss chart. The stocks moved up to 126.06. I originally took in 128 and have a max profit of 10.4%. I want to create a debit spread. So maybe I'm looking at the 125, maybe a 3-point spread. And this is just for next week, mind you, 7 days away. It's creating a Bull Call Debit spread. I have the 128 sold. We're going to look at a 125. Kind of close to a problem, but not really. I think it's going to work and give us a little bit added extra oomph. I'm going to pay another $350 to $380 into this position. I'm going to buy one contract. Take the midpoint at $365. What did I just do? I still own the stock, but now I am in a debit spread where I've sold the 128 at 128. Yes, I kind of did that. It was close to the price. It was 126 at midpoint. I gave it 128 at 128, sorry, on the 17th. And then 365 here. So by itself, we have a net debit into this position of about 237 for a 3-point spread. So that's okay if we get the 3 points back, because just between these two, well, we're sort of gathering 63 cents in profit. All right, so the 237 debit and the 3-point strike difference, that's going to put us at 63 cents additional profit, which is half of that premium. How does that affect the trade? Remember, the original return expected was 10.9 and we were at 6.5. Now the return goes up to 100% and we have this slope here. But the cost basis, 119.55. Of course it's going to go up because we took in 128 and we're paying the 365. So we have a higher cost basis on the position, which means what? If the stock whipsaws on us and starts to move down, we're going to lose on the cost of the long call but keep the full 128 premium, and we're going to be losing delta 1 on the stock position. There are times when if the stock has already exceeded your short call, those call prices below it that are in the money, the cost minus the premium at that time, legging into the debit spread, is going to be higher than the difference in strike prices, and that won't work. This one would potentially work, but it's actually going to lower the profit slightly in these ranges. It accelerates it and it leaves your upside open. But remember, that's not a guarantee that your broker is going to use this long call to deliver your short. The stock goes up above 128. You still have infinite upside, but they still may assign the shares of stock that you originally had linked as a covered call position. That depends on the broker. You want to check with your broker how they would handle that. Buying this extra call might not be linked to the coverage immediately. They still might take the stock, but hey, you still have this long call, which gives you the right to buy the shares of stock now at 125, minus any profit you took in from the assignment, which we saw would have been about 10.4% initially. It looks good. It leaves the upside open. We like that. If it exceeds your expectations, it would add to the cost basis, so you could lose more. If the stock pulls back, then we've got to roll a little bit more here to try to get back the premium we lost with the adjustment on the position. I like to keep it more simple when I'm doing a covered call. If I'm doing covered calls or cash secured naked puts, rather than get too complicated of saying, hey, I started it off with a naked put position, now I want to convert it to A, B, C, or D, just as a different management technique. I want to convert it to a bull put. That's not bad. It adds protection, cuts down the margin requirement. Pretty good, but it's going to lower the premium. I want to change it to a bear put. Well, if the sentiments change, maybe that is a good repair to use. Or just move up and down the covered call. Just move up and down the cash secured naked put. Keep it simple. Don't try to overcomplicate it. Make sure you evaluate the profit and loss in this range to make sure, hey, if it does stay right at 126 or 127 or 127.50, am I seeing the same profit I would if my call had just expired worthless? What are my trade-offs here? What are my trade-offs here? And, well, we can see the trade-offs here. We get that infinite upside, so that's a plus for this management technique over just rolling a covered call. But it all depends on your expectations and what you're looking to accomplish as your trading plan and the portfolio goals moving forward as well. And I think you go on, and I'm not sure if this is related, but you then said if you have a short call against a stock position, the stock is moving higher, but you don't want to have your stock called away. When is it profitable to buy an option to offset the potential short of being exercised? As we talked, David, in the beginning of the presentation, when we talked about it for Anthony, I think the better approach is just to roll it up. It's more common, I understand. It's a more common approach just to roll up the call and you say, hey, I want to leave the upside open and I want to buy a call. Review when we post the archive of Anthony's discussion. Maybe I'll even include this discussion with it. But David, why complicate it? Why not just stay with the covered call strategy and rolling up the covered call rather than converting your covered call into a stock plus a bull call debit or a stock plus a bear call credit after the movement has been made? And the same rules I mentioned for Anthony's case apply. If you let it go too far, the cost you're paying for that lower strike call to cover the hedge so you won't be assigned, and that's not a guarantee, by the way. If I've had a covered call open for some time in my broker and I just buy a call in the same stock, it's not a guarantee that my broker will use that long call to deliver the short call obligation. Some brokers will allow you to link it that way, that's true. But since the older trade was the stock and the sold call, they still might assign the shares. But yes, now I've bought the call that I can use to buy the stock at that call strike price, take the profit from the covered call assignment, and then continue forward. Just be clear, check with your broker because it's not 100% guarantee that just buying a call after you're in the covered call structure will give you that as well. And another follow-up here from David, or a different question from David. He says, I had sold a put late last year on coin. Put was coin at 180. Excuse me, folks. Expiration January 24. Okay. Yep. I got approximately 6,800 at the time in December. It was exercised, so I ended up acquiring 100 shares of coin. I think we talked about this before, David, during a different webinar. I don't remember. Due to the premium paid to me, my average cost of the 100 shares still 112.17. Thinking that coin was not going to do anything in 2023, I sold call March 70 strike. Okay, 17th of March strike against it. And so now the shares are 112.71. I don't want to have the shares called away at 70 as the stock has gone up. So how can I marginalize the sold call economically? Okay, so I can't log on to your account during the presentation. That's one no-no that we absolutely have. You sold the 70 strike for 101. It's now at 16.55. And that, my guess, is due to relatively high volatility, but also that's due to, what do we got? Earnings coming up on February 21st, okay? So you're not going to see a decay in this premium in this case until that time, unless this starts to fall. It's moved up 8 points today. David, I see that. The increase due to the volatility and the mass fluctuation in coin, of course, is going to also have an effect on that high price of 16.55. Oh, it's so far out in time, though. I'm sorry. Yeah, I was wondering about that. 0.772 does not seem as high as I thought it was. I'm still think I'm looking in March because that's what I wanted to look at. That's when you were assigned. I so apologize. There we go. That's much better. 6.35. There it is. 1.04. That makes much more sense. With earnings coming out at the end of February, Marches are going to be highly affected by that. Okay, so Let's think about this just for a moment. I'm sorry. Let's clear this all out very quickly. And we've got COIN. And after everything, but before you sold this call, you said, great. Okay, so you've got shares. 100 is fine to use. It doesn't. I don't need to do any more than that. It doesn't matter if you have 1,000 or how many contracts you sold. But the point is, we have a covered call right now with a cost basis of 112.71. And we've got your coin position here, March 17th. Didn't expect coin to do anything, so you sold the lower strike call at the time for 101. Cost basis drops down to 1170. Potential to be assigned at 70, capping a loss of 4170 or 37.3% on the position with the premium involved. And now, of course, the buyback cost we saw with the earnings coming up is pretty high. The stock jumped to 835 today and fluctuates as always all over the place. So let's just put that in. So again, I just want to see what opportunities are available, and you can tell as well as I can that even some of these positions are, the further out at positions, I'm sorry, David, are going to be inflated as well. And why that's a good thing is you could still roll for a credit, but I don't think you're going to see any positive return. But instead of being potentially locked into a loss of 45%, or that maximum loss we saw in the profit and loss chart of 37.3%, we can lower that slightly to these ranges by rolling up, but you're going to minimize the positive credit. You're going to keep a positive credit and increase the potential up to higher strike price, but we're going to be rolling out to April. We're going to be rolling out to June in those cases to give yourself a little bit more room, a little bit more wiggle room in those cases. So even though it's going to cost you $530 more to buy this call back, there's opportunities to roll for a credit, but you're going to have to go further out in time, which is expected, due to the high implied volatility, which is related to the earnings coming up in the near term. As we saw with Anthony's position, I think it's going to be a better example. You're wanting to hedge the 70 loss by buying a lower strike call to create a bull call debit spread. I'd want to target the same expiration, excuse me. Remember, you only collected $1. So this might work. You could buy the 60 call. That's going to cost you $980. In other words, you're going to add $980 into this position roughly. Well, the midpoint is a little bit different. Let's take a look. It's 1010, excuse me. So you're going to pay an extra $1,000 into this position. Whereas if you wanted to keep lowering the cost basis of the trade, we saw that you could be rolling the position for a positive net credit. In other words, yeah, you're going to pay $635 to buy your call back, but you're going to get another $560 plus the 101 you took in. Okay, not fantastic, but it's still a positive net credit. Here's other positive net credits, but again, you're close to that same strike price where you were at 70 that you're worried about because the stock moved up 8 points today. So there's opportunity there. This adds $1,000 to the cost basis total. Puts you back up to 121.80. And here's that strange situation. The break even is now at 111.81. I'm sorry, 111.80, which is good. You get this sort of flux of price, but the risk is increasing from where you are because of the extra $1,000. You're really adding an extra $900 roughly to the position because you keep the 101. But look at that spread together. $10 here, $1 here. Okay, $9 net debit for 10. It's not too bad. You're getting $1 benefit payoff, and that's why you're seeing this increase in the prices, and it does leave the upside open. But again, not a guarantee. What could happen in worst case scenario? The stock drops back down that 8 points, back down to 52. You lose the $10 on the long call, and you've lost another range on the stock position, the 1 delta at the liquidation value. So now you might actually be at a 40% loss, 42% loss instead of where we saw in that case. Actually, I'm sorry, you're at a 50% loss with the max potential of only a 37% loss if the stock's above 70 on March 17th expiration. So this one is able to be done. But think about it this way. If the stock's trading at 65, this 60 call might be up at $16, a little bit up. It's probably going to be at $17. Well, you buy the 60 call for 17 and you've sold the 70 for 1. you've got a $16 debit on a 10-point strike difference. That's going to really add to the cost basis. You're going to see this break even extend further upwards, even with this move in between, because the net debit was greater than your difference in strike prices that you can get back. The cost into the position is going to drastically increase it in that case. So, as you can tell, not totally a fan of this movement. I like to keep it more simple. I'm not a fan of this adjustment. I love the fact that it leaves the upside open, but I'd rather see investors do this at the beginning as opposed to trying to do it after the fact, especially in a large movement, because that can get you in trouble. Yes, it leaves the upside open, but you're going to be adding to the cost basis. The benefit of having the debit spread here might not pan out if you're paying too much for that long call now that the stock has moved up further in price. When would be the best time to do it? It's tough to say. It really is. I mean, I think this might be a good time to do it. If the stock's at 65 between the strikes, you might look at the 65 and hope that you can get that at a better price. The 60 might be too expensive, but maybe just like doing a ratio or a repair or stock repair, the best time to do that is when the stock's between the strike prices. I'm not really clear, because as we're getting closer to as we're getting closer to earnings, the implied volatility might keep increasing, meaning the buyback cost of your initial call is increasing. And this one as well is increasing. So you're in a double whammy where it's costing you more to buy this back, and it's costing you more to buy this position to get this structure, which could get you into trouble too, especially in a whipsaw effect, depending on what happens with coin and what other positions. Shishir says, if not today, the next time, when would one look to roll the call up? Well, that's usually one would look to roll depending on what your target is. That's hard to explain, not hard to answer, Shishir. It's easy to answer, but if you're with an in-the-money covered call that I mentioned before for the 1%, trying to target that return with the safety and protection, you don't roll it. You get assigned. Take assignment, take your 1% that you wanted for the 2-week period or the 1-month period. Then you run the search the next week, see which stocks match that criteria, and enter those stocks. You're not married to a stock position with that approach or with a naked put. You want them to be assigned in the covered call or expire in the naked put. You're not worried about rolling it at all. You want it to be assigned. If it starts to move against you, yeah, usually when the stock drops 5 to 7% from where you opened it, you're going to consider rolling down or maybe just getting out of the position because you were wrong on the direction. Why try to force a repair if the stock's not going the direction that you want for the strategy? And if you're in an out of the money cover call like we talked about with Anthony or here with David, and you don't want to be assigned, well, the best time to do it is usually when the stock approaches the short call strike price. The problem is, I think that David sold this call when the stock was at a really, really low price. I don't think he mentioned that, but we've been as low as 30, and as he mentioned, he didn't expect it to do much in the first part of 2022 or 2023, so he might have sold it, and then boom, just at the end, beginning of 2023, seen almost 100% increase in the stock. Not quite, but it's close. About 32.50 up to where we are now at about 61.37. So it's almost there. Yeah, well, not the 217.49, but that he was saying he expected it to stay the same and stagnate in this $40 range, so he wanted to get something. But now it's moved up so quickly that he's still good range out of the money monetarily. The implied volatility is so high, the earnings are coming up, the buyback cost is extreme compared to what he got for it, not expecting this type of move in the first 3 to 4 weeks of 2023. That's what caught him off guard. So hindsight's 2020, and it's different for each position. If I didn't have earnings coming up and I had a normal $60 stock with implied volatility of 0.25, even though the stock is doing this, well, I wouldn't have been able to sell the 70 call, let's be honest. I probably would have sold at the time, maybe the 40 to be out of the money. Well, once the stock reached this point and it started moving at to above the short call strike and I didn't want to be assigned, that's when I'd move it up. But I'd look to roll for a credit, so I might have gone from a 2-week out trade to a 1 or 2 month out further trade. I might already be in February expiration. If I started in January, if I started in February, I might already be out to March. Now that's starting to go above that price again, I'm probably rolling from March maybe to April. Or maybe I just want to decide that's it. I'm just going to leave it. I'm happy I've moved it up. I can get a 9% return in April if the stock stays above the strike price. Maybe I could buy the call to get more as well. And there we go. All right. And David says earnings are projected to be a loss of over $2. Okay, so is that within Wall Street's margin of what they're expecting? Because remember, if Wall Street's expecting a loss of 180 and they lose $2, well, the stock would probably plummet. If they're expecting a loss of $5 and coin only shows a loss of $2, the stock might actually shoot up. You got to keep that in mind, the complete unknown there, David, with the earnings. And it's all based on the forward-looking aspect as well. That's the tricky part also. So yeah, check with your brokers. They probably have some more detailed information, the earnings of expectations and so forth of what they expect. You said are expecting a loss of $2. I don't know if that's the expectation or what people are reporting, or if that's the actual quote unquote Wall Street expectation of what their monetary value, monetary profit or loss is going to hit, and per share loss is going to hit, revenue and so forth. So you want to check that out, see if you can get more information. Your broker probably has that for you, and just give it a look. All right. And last but not least, I apologize, Shishir, as with everything else. And no, I'm not trying to just slough off education. I'm not trying to slough off your questions. Believe me, that's the last thing I would do. But there's a vast amount here. When to roll in the money covered call. Just use a search of when to roll or let expire an out of the money covered call. That's from 1 year ago. That's kind of close to what you're talking about. Look at when to roll an out of the money covered call. To roll or not to roll in the money covered calls. Criteria for the optimum time frame to roll a covered call. This one was kind of fun. Let's see here. Yeah, to roll or not to roll out of the money covered calls. So there's a wide variety, Shishir, there that a lot of times that when I reference this is because we've already covered these topics. And I think between this topic here, I remember this one, the criteria for the optimum time frame. And I think, when is it worth it to roll in the money? I'm trying to look for, oh, there it is. You might want to check this one out too. This is a little bit different. Your question was also on expiration or a different time period. This one goes a little bit more in depth. We had some fun with this one from 7 months ago. Is it better to roll on Friday or close it and sell a new call on Monday for a covered call position? We look at the time value decay of a couple theoretical options positions, well, actual trading prices, but not real trades, just ones we looked at using the historical chain. So look at what would the expected return difference be if we rolled the covered call on Friday to the next Friday before expiration, or on Thursday, I believe too, and compared that against closing it on Friday, not leaving a call open for the weekend, and then opening a new call on Monday. So that one's pretty interesting. Just, when to roll, and you'll see some of these concepts here. Some of these are pretty quick, 13 minutes, 18 minutes, not too bad. 23 minutes, not too bad. 9 minutes, that's an older one though. And that one about the Wednesday and Saturday is 1850. Yeah, so you've got some rolling a covered call that goes against you. That's going down, though. That's not what we're talking about here. There it is. That's the other one. When is it beneficial to roll a covered call, Shishir? That's one you might want to take a look at as well. So I think the big three here, rolling a covered call, when is it beneficial? And we're mostly talking about out of the money here, to roll or not to roll out of the money covered calls. Maybe criteria for the optimum time frame, that one as well. And when to roll or let expire an OTM covered call, and the best time to roll also. So check those out there. Good follow-ups. And some of those are actually, one or two of those is actually in that playlist, in the covered call playlist as well. So you can check it out there also. Okay. So it's just that it is 6 o'clock. We've got 8 videos that range between 12 minutes to 20 minutes long already on the topic. I don't want to rehash all of it right there. I'm just going to point you in the direction, but then encourage you. Once you watch 1 or 2 of those videos I just referenced, write down your questions. And as always, send me an email or schedule a coaching session. And we'll go through the 3 or 4 or 5 questions you have on the videos I pointed you to as well.